Most people think the upgrade is more money. It is not. The upgrade is control. Control over who decides when liquidity moves, under what conditions, and to whom. That is a system wealthy families have been running for generations. Not a budget, not a savings account, a set of rules about capital. And it starts, like most things, much smaller than you think. Level 1. You have $10,000 in a high-yield savings account. Call it what it is, that is a balance sheet. A very small one. One asset, one purpose. The asset is cash, the purpose is continuity, which means your life does not stop when something unexpected costs money. A transmission, an ER visit, a landlord who decides not to renew. The $10,000 is not there to grow. It is there to prevent the kind of interruption that makes a bad situation a permanent one. You are not a bank yet, but you have a balance sheet. That distinction matters. Here is what it protects. A single unexpected expense under $10,000 does not become debt. You do not put a $3,800 car repair on a credit card at 24% APR. You do not borrow from your 401k and lose the compounding. You absorb the shock and replenish. Here is what it does not protect. A sustained income disruption. 3 months without a paycheck. A medical situation that exceeds the account balance. A layoff in a city where your rent is $1,700. The $10,000 buys time. It does not buy safety. Those are different things. And yes, there is an opportunity cost. $10,000 at 4.7% APY earns $470 in a year. $10,000 in a total market index fund has historically earned closer to $700 to $1,000 annually on average, though not every year and not predictably. The emergency fund earns less by design. The cost of that design is the gap between those two numbers. The benefit of that design is that you never sell an index fund at the bottom of a correction to pay for a broken furnace in February. Fragility is expensive in ways that do not show up in a yield comparison. Level 2. You have moved past the question of whether you can handle a surprise. Now you are asking whether you can handle something you already know is coming. Because most financial shocks are not really surprises. They are predictable events with unpredictable timing. Your car has 94,000 miles on it. It will need something. Your health insurance has a $6,000 out-of-pocket maximum. You could hit it. You have been meaning to move closer to work for 2 years. That move will cost money. These are not emergencies. They are scheduled draws against a balance you either have or you don't. This is where sinking funds become the second tier of the system. You open 3 or 4 accounts. They are labeled, not combined. One says car. You put $150 a month in it. After 20 months, it holds $3,000. The timing of the repair does not matter because the money already exists. One says medical. $200 a month. 1 full year of contributions puts $2,400 toward a $6,000 maximum. It is not fully funded, but you are not starting from zero either. One says move. $300 a month. After 14 months, you have $4,200. The security deposit is $1,000, $1,200. The security deposit and first month and the truck rental do not require you to drain every other account simultaneously. One says travel or transition. Whatever the word is for the thing you know you want but don't have a date for yet. $100 a month. You stop treating it as a luxury and start treating it as a scheduled event with a funding timeline. The system is not complicated. The effect is that predictable shocks become draws rather than crises. You already made the decision. You made it 14 months ago when you opened the account. That is a version of governance. Slow, deliberate allocation followed by fast, frictionless execution when the moment arrives. Level 3 is where families enter the picture and where most of the damage happens. Someone needs money. It might be a sibling, it might be a parent, it might be a cousin who is genuinely struggling and genuinely trustworthy and has never asked for anything before. It does not matter. What matters is whether you have a policy before the ask arrives. Because if you do not, you are making a financial and emotional decision simultaneously under pressure, and that is the condition that produces outcomes nobody wants. Here's a scenario that happens in real families. Your younger sister calls in October. She is $2,200 short on rent. She is between jobs. She is not reckless. She just got behind. You say yes because she is your sister. You transfer the $2,200. No terms are discussed. No timeline is mentioned. February arrives. She has a new job. She does not bring up the $2,200. You do not bring it up either. March arrives. You need $1,800 for the car account because the repair came early. You are short. You feel something toward your sister that you do not have a clean name for. It is not resentment exactly. It is the feeling of someone who gave a gift they labeled a loan. The failure was not generosity. The failure was ambiguity. A simple policy prevents this. The policy has 4 parts. A cap, the maximum you will give or lend in any 12-month period to any single person. A frequency limit, once per rolling year, not twice, not 3 times, once. A trigger, what situation qualifies and what does not. And a no surprises rule, which means both sides understand the terms before the transfer clears, not after. At this level, control means knowing in advance what your answer will be. Speed of access, emotional clarity under pressure, and the first version of who can say yes to what. That is governance, not a spreadsheet, not a policy document. A decision you made before the phone rang. At some point, the informal transfer stops being enough. The ask is not $2,200 short on rent. The ask is $25,000 to pay off high interest debt before a home purchase. The ask is $80,000 toward a down payment from parents who have it and want to help and genuinely believe they are giving their child a better start. The ask is real. The amount is real. And at that size, the difference between a conversation and a contract is the difference between a family that stays intact and one that spends the next decade managing a wound nobody will name out loud. This is level 4, the intra-family loan. Here's what it looks like in practice. A parent lends $25,000 to an adult child at 4.5% interest, a rate chosen because it is below what a bank would charge but above 0, which matters for reasons we will get to. The term is 5 years. Monthly payment is $466. That is written down in a document called a promissory note. It specifies the principal, the rate, the schedule, and what happens if a payment is missed. The document exists not because anyone expects the relationship to become adversarial, but because the document is what keeps it from becoming adversarial. Writing it down is an act of respect, not suspicion. It says, this is real. We both understand what we agreed to, and we are treating each other like adults. The rate matters for a reason that has nothing to do with profit. The IRS publishes something called the applicable federal rate, a minimum interest threshold for loans between family members. If a loan is made below that threshold, the government may treat the difference as a gift, and gifts above annual exclusion limits can create reporting obligations. That is not tax advice. It is an explanation of why the number is not arbitrary. The rate exists to keep the transaction recognizable as a loan rather than a gift in disguise. Understanding that distinction, gift versus loan, is not optional once the numbers get large. It is the architecture of the whole thing. Now here's what happens when payments stop. Month 7, the borrower misses a payment. Nothing is said at a family dinner because nobody wants to be the person who brings up money at a family dinner. Month 8, same. By month 10, the lender has absorbed 2 possibilities simultaneously. 1, the loan is quietly becoming a gift they did not choose to give. 2, the relationship has acquired a layer of silence that will outlast the balance. The promissory note does not prevent this, but it gives both parties a structure to return to. It makes the conversation about the document rather than about the person. That is the point. Level 5 moves a structure off the kitchen table entirely. A family forms an LLC or a limited partnership. The shared cash now lives inside an entity, not in someone's personal account. There is accounting. There are capital accounts that track who contributed what. There is an operating agreement that governs withdrawals, decision rights, and what happens when one member wants out. A family of 4 siblings with $200,000 pooled into an entity for real estate investment is not just sharing money. They are running a small institution. The separation is real. The disputes become formal. One sibling contributes more and expects more say. Another takes a distribution early and the others find out later. The entity structure does not eliminate conflict. It changes the terrain on which conflict occurs. The fights become about the operating agreement rather than about trust. That is an improvement. It is not a solution. Level 6 is infrastructure, trusts, family governance documents. A trustee who is not a beneficiary and whose job is to hold a legal standard, not a family preference. A distribution committee with written criteria for when money moves and to whom. A family charter that says, in plain language, what this capital is for and what it is not for. These structures exist because every family that accumulates enough eventually confronts the same problem, which is that generosity without rules produces moral hazard. One sibling figures out how to work the system. One asks more than others because asking has no cost. One stops contributing because the pool exists whether they do or not. The trust document and the family council are not cold. They are the attempt to make the system durable past the generation that built it. The failure modes at every level are the same in different clothes. Favoritism dressed as discretion. Collateral that was never specified and cannot be collected. A loan that everyone knows has become a gift, but nobody will say so. The sibling who borrowed $40,000, made payments for 8 months and then stopped, and is still invited to Thanksgiving, and will be next year and the year after, because some things are more important than the balance and everyone knows it and nobody has found the right way to account for it. The system does not eliminate those dynamics. What it does, when it works, is give the family a place to have those conversations that is not the dinner table. It moves the conflict from the relationship into the structure. That is not a small thing. That is the entire point of building one. At a certain scale, the family stops being a borrower. It becomes a lender. Not metaphorically, literally. The entity has enough capital that it can originate loans, set terms, and collect interest the way a bank does, without being a bank. This is level 7, private lending as a portfolio. And the shift in how you think about money at this level is more significant than any of the dollar amounts. A family with a $2 million lending pool deploys it into hard money loans, real estate notes, and small business bridge financing. The mechanics are straightforward. You identify a borrower, you underwrite the deal, you set terms, you get paid. The underwriting is where emotion leaves the room and numbers take over. Loan to value at 65% means if the borrower defaults and the asset sells at a 30% discount under pressure, you still recover principal. Target yield is 10 to 12% annually on secured notes. Default reserve is 8 to 10% of the portfolio held in liquid form, because some loans will go bad and the reserve is what keeps a default from becoming a crisis. The discipline is not in the rates. The discipline is in the standards you hold when a deal looks attractive and the LTV is 75 and you tell yourself the collateral is strong. The deals that blow up are almost always the ones where someone bent the underwriting to say yes. The family that reaches level 8 has stopped thinking about returns and started thinking about optionality. This is the family office treasury mindset. Liquidity ladders, banking relationships that are not transactional but structural, credit lines arranged against marketable securities that can be drawn in 48 hours when a deal appears. Collateral managed across accounts so that the family always knows exactly how much dry powder exists and at what cost. A family with $30 million in assets and a $10 million securities-backed credit line does not have $30 million in capital. It has $40 million in deal capacity when the right moment arrives. Wealthy families optimize for deal speed. Because when credit tightens and other buyers cannot close, the family that can wire funds in 3 days is not just buying an asset. It is getting paid a premium for liquidity that the market cannot provide. At $100 million to $500 million, the model changes again. The family is no longer deploying capital. It is controlling credit creation. It sets terms, not receives them. It decides who gets access to liquidity and at what price. It earns a spread between its cost of capital, often near zero against its own collateral, and what it charges borrowers who cannot access that same credit. That spread is structural income. It does not require a new idea each year. It requires governance. The $500 million Dynasty lender has a simplified balance sheet that looks something like this. Cash and equivalents, $40 million. The floor that never moves. Marketable securities, $180 million. Liquid, collateral eligible, compounding. Operating assets, businesses, real estate, $200 million. Illiquid but cash flowing. Lending portfolio, $80 million. Deployed across secured notes at 65% average LTV with a 10% reserve held in cash. Against that balance sheet, there are lending programs with written criteria specifying asset class, geography, maximum single loan concentration, and yield floors. There are risk limits that cap any single borrower at 5% of the lending portfolio. There are governance layers, an investment committee with external advisors, quarterly reporting, and a defined process for when exceptions can be made and who signs off. The structure is not bureaucracy. The structure is what keeps a $500 million institution from making $50 million mistakes because someone was confident. Now here's the dark side, because there always is one. Concentration is the first failure mode. A family deploys $60 million into real estate notes in a single metro. The market softens 20%. Borrowers begin missing payments simultaneously because their underlying properties are all tied to the same economic conditions. The defaults are correlated. The reserve that looks sufficient against isolated defaults is not sufficient against a cascade. The portfolio takes a $15 million impairment in a single quarter. This has happened. It will happen again. Leverage is the second. A family borrows against its securities to fund the lending portfolio, earning the spread. When markets move against the securities, the bank calls the credit line. The family must sell securities at a loss to meet the call precisely when liquidity is most constrained. Leverage that looked like efficiency on the way up becomes the mechanism of destruction on the way down. The third failure mode is governance collapse. A second-generation patriarch decides to override the investment committee and extend a $20 million loan to a business run by his college roommate at a rate and LTV that no committee would have approved. The loan goes bad. The loss is the small part. The larger part is that the committee now knows it can be overridden, and the family has learned that the rules apply to everyone except the person who made them. Trust is the infrastructure that takes 20 years to build and one override to fracture. There is also what might be called intra-family capture. A family member sits on the investment committee, routes deals toward entities they own, and earns fees on both sides of the transaction. Nobody calls it fraud, they call it alignment. The distinction matters in court. Here's the takeaway. Every level of this system is available to anyone who builds enough capital and enough discipline to operate it. But the complexity compounds faster than the capital does. Before money moves at any level, write down who has decision rights, what the approval threshold is, and what happens when someone violates the rules. That document is not a formality. That document is the bank. If this kind of systems level infrastructure is the thing you want to understand, subscribe. There is more of it, and none of it is as complicated as it looks from the outside once someone has shown you the architecture.